few months ago, a family member asked me what they should invest in. They wanted something easy and simple, and my answer was straightforward. Buy a global equity ETF. And they're certainly not alone. Over the last decade, investing through ETFs has exploded. Today, trillions of pounds are invested in them, and for millions of people, they've become the default way to invest. And it's easy to see why. They're low cost, simple to buy, and instantly give you exposure to thousands of companies around the world. Global equity ETFs are often called passive investments, but passive doesn't mean there are no choices. When you choose an ETF, you're choosing both the companies you own today and the rules that will shape your portfolio over time. You might think that buying an ETF means taking investment decisions out of your hands, but in reality, you're deciding which set of investment rules you want to follow. Now, this isn't a video arguing against global equity ETFs. I think for many investors, they're an excellent choice. But every set of investment rules comes with trade-offs. So in this video, I'm going to explore 5 risks that are built into every global equity ETF. One of the biggest selling points of a global equity ETF is diversification. Take Vanguard's FTSE All-World ETF, VWRP. It holds almost 3,800 companies from around the world. So surely that's about as diversified as you can get. Well, yes and no. Because diversification isn't just about how many companies you own, it's also about where your money is invested. Today, almost 62% of VWRP is invested in the US. So although you own thousands of companies, most of your investment is concentrated in a single country. But countries rise and fall. In the late 1980s, Japan represented a much larger share of the global stock market than it does today. Then Japanese equities underperformed for decades, and Japan's weighting gradually shrank. That doesn't mean the US will follow the same path, but if US equities were to underperform, this ETF would be heavily exposed. The same thing happens with sectors. Today, technology accounts for more than a third of the index. That is a large weighting for a single sector. And it hasn't always been this way. Technology's share of the global market has risen dramatically over the last decade, alongside the growing dominance of the US market. Zoom out even further and the picture changes again. At the start of the 20th century, markets were dominated by railways. Today, they're dominated by technology. If technology underperforms in the future, a global equity ETF with this level of exposure is likely to struggle too. The same pattern appears at company level. Although VWRP owns nearly 4,000 companies, around a quarter of the fund is invested in just 10 of them. In fact, concentration in the very largest companies has increased significantly in recent years. And history reminds us that the names at the top do not stay there forever. The largest companies in the 1960s, the 80s, and the 2000s looked very different from today's list. Some disappeared from the top altogether, others were overtaken by the next generation of winners. So although you own thousands of companies, your performance is still heavily influenced by a relatively small number of them. But there is a choice you can make. A market cap weighted ETF allocates more money to the largest countries, sectors, and companies. But that isn't the only way to build a global equity ETF. An equal weight ETF gives each company broadly the same weighting, creating a very different portfolio. In this equal weighted ETF, the 10 largest holdings make up less than 2% of the fund. Of course, every choice has trade-offs. Recently, market cap weighting has outperformed because the largest companies have continued to lead the market. But that might not continue. The important point is that when you buy a global equity ETF, you are also choosing how concentrated you want to be in particular countries, sectors, and companies. The second risk is valuation. The price you pay for an investment is one of the biggest drivers of the return you make. A global equity ETF does not ask whether the companies it buys are cheap or expensive. It simply owns them because the rules says it must. One way of measuring valuation is the price-to-earnings ratio. This compares the price investors are paying with the profits companies are producing. The higher the ratio, the more investors are paying for each pound of earnings. And by this measure, global equities are currently expensive compared with much of their own history. The picture becomes even more extreme when we look at the US, which, as we have already seen, makes up most of a global equity ETF. The CAPE ratio compares share prices with the average inflation-adjusted earnings over the previous 10 years. Today, the S&P 500 CAPE ratio is close to some of the highest levels in its history. That does not tell us when the market will fall. Expensive markets can become even more expensive and stay expensive for years, but the price you pay still matters. And historically, investors who bought the US market at lower valuations generally earned higher returns over the following 10 years. Those who bought at higher valuations generally earned lower returns. The relationship is not perfect, but the direction is clear. So with global markets, and particularly the US, trading at high valuations, one risk is that expectations become too optimistic. If valuations mean revert, a global equity ETF could be hit hard, even if company profits remain healthy. But again, there is a choice you can make. You do not have to own every part of the global market in proportion to its current size. There are other ETFs that take a different approach. A World ex-US ETF reduces exposure to the most expensive part of the global market. As you can see, it has a very different makeup, with Japan being the top country, financials being the largest sector, and the top 10 holdings being much less concentrated. A value ETF goes further by selecting cheaper companies across different countries and sectors. Again, this gives a different portfolio which will perform differently. Over the past year, you can see the performance of these three different types of global equity ETFs. The way an ETF is constructed has a real impact on how it performs. A market cap global equity ETF does not protect you from overpaying. It automatically invests the most money in the markets and companies that have become the most valuable, even when their valuations are already high. When you buy a global equity ETF, you're not just buying the stock market, you're buying the market at today's prices. The third risk is more controversial. The possibility of an index bubble. Over recent decades, more and more money has moved from actively managed funds into passive index funds. Today, passive funds now hold around half of all US fund assets. Some investors worry this changes the way markets behave. An active investor decides whether a company looks attractive at its current price. A passive fund doesn't make that judgment. When money flows into the fund, it simply buys companies according to the rules of the index. As we've already seen, that means the largest companies receive the biggest share of every new investment. Today, Nvidia is the largest holding in VWRP at 4.7%. Imagine someone invests £1,000 every month into VWRP. The ETF uses £47 of that money to buy Nvidia. Because of the volume of the money going into Nvidia, this causes the share price to rise, so that the next month Nvidia is 4.8% of the index. So the next month the investor adds another £1,000, but now £48 goes into Nvidia, causing the share price to rise again. If Nvidia keeps rising, each new investor buys a little more. And critics argue this creates a feedback loop. As a company's share price rises, its weighting in the index rises too, meaning passive funds automatically direct more new money towards it. But the same mechanism works in reverse. If investors start withdrawing money, passive funds sell according to exactly the same rules. The biggest holdings see the biggest selling. And critics argue that during periods of market stress, this could amplify market moves. This is the concern raised by investors such as Michael Burry. He compared the growth of passive investing to a crowded theatre where the exit remains the same size. The fear is that if large numbers of investors try to sell at the same time, passive funds could amplify market moves. And some recent research also supports this conclusion. The authors argue that passive investing can reinforce price trends because market cap weighted funds direct increasing amounts of money towards companies whose prices have already risen. Their research also suggests that stocks held heavily by passive funds are increasingly moving together, reducing some of the diversification investors might expect. And during a market sell-off, passive funds could also end up selling broadly the same companies at the same time, which could amplify stock price falls. Now, this remains a debated topic. But the rapid growth of passive investing has undoubtedly changed the structure of markets. And we don't yet know exactly how a market increasingly dominated by passive investing will behave through every future crisis. The fourth risk is currency. When you buy a global equity ETF, your return does not just depend on what happens to the companies you own, it also depends on what happens to the currency. Imagine Apple's share price does not move at all. If the pound falls by 20% against the dollar, the value of those Apple shares rises when converted back into pounds. So even though Apple's share price hasn't changed, a UK investor would see a 20% gain simply because of the currency movement. But the reverse is also true. If the pound rises by 20% against the dollar, the value of those same shares falls when converted back into pounds. So even though the share price hasn't moved, the UK investor could still lose money because of the currency movement. And this matters because almost all of a global equity ETF is invested outside the UK. Only around 3% of VWRP is invested in British companies. Around 62% of the fund is exposed to US dollar, with further exposure to the euro, Japanese yen, and other currencies. So when you invest in VWRP, you are also taking a significant exposure to foreign currencies, even though the ETF itself is bought and sold in pounds. The currency it trades in does not remove the currency exposure of the underlying companies. And currencies can move significantly. Since the early 1970s, the pound has roughly halved in value against the dollar, although the journey has been far from smooth. There have been long periods when a weak pound boosted the returns of UK investors holding overseas shares. But there have also been periods when a stronger pound reduced those returns. But once again, there is a choice you can make. You can own an unhedged ETF and accept that currency movements will affect your returns, or you can choose a hedged ETF, which aims to reduce the impact of changes in exchange rates. Over the last 10 years, the unhedged and hedged funds have produced different returns even though they own the same underlying companies. And this chart shows how much a difference this can make when currencies move. All that excess return you see in the chart did not come from the underlying companies performing better. It came from the movement in currencies. Sometimes that works in your favor, sometimes it works against you. When you buy a global equity ETF, you are also making a decision about currency exposure, whether you realize it or not. And the fifth and final risk is maybe the most obvious one: equity risk. A global equity ETF might own thousands of companies across different countries and sectors, but it is still 100% invested in equities. That means it remains exposed to the risks shared by stock markets as a whole. Diversification can reduce the damage caused by one company failing, but it cannot protect you from a broad market crash. And market falls are not rare. Throughout its history, markets have regularly suffered declines of 10%, 20%, or more. Some crashes have been especially severe. During the Great Depression, US equities fell by almost 90%. A dot-com crash saw the market fall around 78%, while the global financial crisis produced a fall of roughly 50%. Even the much faster COVID crash briefly wiped around a third from the market. Those falls were eventually recovered, but living through them is very different from looking back at them on a chart. A £1,000 portfolio falling by 50% becomes £500. It then needs to rise by 100% simply to get back to where it started. But once again, there is a choice you can make. You do not have to invest all your money in equities. You can combine shares with other assets that may behave differently during a market fall. This chart compares how different asset classes performed during the crashes of 2008 and 2020. Global equities suffered the largest losses. Government bonds, inflation-linked bonds, and cash generally fell much less, while some produced positive returns. That does not mean those assets are risk-free or that they will protect you in every crash, but spreading your money across genuinely different assets can reduce the size of any fall. And the difference can become especially important when markets take years to recover. During the period covering the dot-com crash and the global financial crisis, a 100% equity portfolio suffered 2 deep declines and remained below its starting value in real terms until around 2013. A traditional 60-40 portfolio still lost money at times, but its falls were much smaller and it recovered considerably sooner. The trade-off is that holding bonds or other defensive assets will normally reduce your returns when equities are performing strongly, but they may make it easier to remain invested when markets fall. And you do not necessarily have to build this type of portfolio yourself. Multi-asset funds combine equities with bonds and sometimes other investments within a single fund. For example, this BlackRock fund currently holds around 2/3 in equities and 1/3 in fixed income. It will not avoid market losses, but it should normally fall less than a portfolio invested entirely in global equities. A global equity ETF can be an excellent long-term investment, but owning thousands of companies does not remove equity risk. When you buy one, you are choosing to accept the full rises and falls of the global stock market. So global equity ETFs can be excellent investments. They are low cost, simple, and highly diversified. But they are not risk-free. And passive investing does not remove the need to make choices. When you buy a global equity ETF, you are making choices. Those choices may still be right for you, but the important thing is to understand what you own, along with the rewards and risks that come with it. Thanks for watching.